Canada. Let's bring in Dennis Mitchell, one of our longtime friends, CEO and CIO at Starlight Capital. Dennis, nice to see you.
Great to see you, John.
Why don't we start with the Fed before we get into the Bank of Canada? But what will you be watching for as a professional investor with this Fed news today?
Sure. I mean, usually what everyone is looking for is changes in this statement from the prior statement, any sort of foreshadowing or any sort of breadcrumbs you can follow towards where they're thinking. So I think right now what you're looking for is them talking about the balances of risks, right? Talking about business investment, the labor market, because those are the things that have really proved resilient in the U.S. economy. Businesses have continued to invest, they've continued to hire people, households have continued to consume, right, and spend. And so if those two things continue to be resilient, then you can see the Fed kind of signal that right now they're satisfied and they don't see any impetus or reason to accelerate the rate cut outlook right now.
And does a resilient economy, should people be pleasantly surprised by that development if that is the case?
Well, Q3 GDP growth was almost 5% in the U.S., and it slowed to just over 3% in Q4. So I don't think anyone should be surprised that the U.S. economy is proving resilient. It's been resilient for a couple of years now. So I think the question really is, how long can this continue or persist, given we've gone through a significant rate hike cycle and businesses historically respond by slowing investment and slowing hiring when that happens? So I think the more concern for investors is how long will this elevated level of growth, because this is higher than the long-term average of about 3.5%. So those two things can't coexist for an extended period of time. So it's a question of when will GDP growth start to moderate?
And let's transition to the Canadian economy, which arguably got some help because of that resilient American economy. But we were just looking at some numbers yesterday. Equifax was talking about worries in our business community, insolvencies higher, people grappling with some of these, various inputs that make their businesses run. And at a time when there are some signs of inflation easing, which we saw this week, what does that make you think about the road ahead for interest rates in this country?
Right. So I think there is an increasing possibility that the Bank of Canada might actually cut in April as opposed to June. And the reason for that is some of it is financial, some of it is just window dressing, if you will. Like at the April meeting, there's a monetary policy report that will be released, whereas in June that won't be the case. That will be the case in July again. And then you've got a business outlook survey that'll be released again in April as well. So there's the chance for the Bank of Canada to kind of telegraph exactly what's happening in the Canadian economy and why they're responding by cutting rates sooner rather than later. And then the other thing to keep in mind is that Tiff Macklem, when he testified or spoke to Parliament, was very specific about the housing market, the challenges that will create for the Canadian economy. So cutting rates sooner in April, as you're getting into sort of the seasonally strong period for the housing market, would make a lot of sense to address that issue as well. And then finally, cutting sooner than the Fed would also weaken the Canadian dollar, you would expect, versus the US dollar. And if I look at the weakness in GDP growth in Canada, it's been a function of lack of business investment and lack of consumer spending. The consumer side is understandable. If your mortgage rate's about to double and your payments going up, $400 or $500 a month, you're going to start ratcheting back. But that puts downward pressure on GDP growth. And similarly, if businesses are investing less, again, that puts downward pressure on GDP growth. One of the things that did support GDP growth in Canada, international investment. If the Canadian dollar is weaker, you would expect international investment to pick up. So I think there is a growing narrative and an argument for cutting in April versus waiting until July in Canada.
That's a helpful connection of all the dots that make up an economy. I guess the one thing we've heard repeatedly from economists is if central banks were late to the inflation fight and don't want to make the same mistake twice, that they might err on the side of caution and just hold out a little bit longer if they feel the economy can handle it. How do you feel that argument is going to, will it stand the test of time over the course of this year?
Yeah, I think, if you're driving in, late at night and you're tired and you start to nod off, when you get that shoulder and you hit that part that's chewed up on purpose and it wakes you up, all of a sudden for a little while, you're hyper aware, right? You're hyper awake. So I think that's what's happened to central bankers around the world. They certainly got complacent, right? The narrative was, what was that word again? It wasn't persistent. It was transitory.
Oh, transitory, yes.
Yeah,
thank
the word
you.
was transitory.
Which is literally our bumper sticker for a while. Yeah.
So everyone, everywhere has now woken up, right? They've hit the shoulder. They've woken up. They're awake. They got both hands on the steering wheel. So I don't think we really have to be worried about them being too soon or too early right now. And if the Bank of Canada doesn't move until July, I think that's probably a missed opportunity, but I don't think it'll have a huge dramatic impact on economic growth in the Canadian economy this year and even into next year. So I think everyone's awake at the wheel right now and hyper-focused on what the data tells them they should be doing.
All right. Well, you're driving this car, so I got one more question for you here. On a pivot to rates, if we see one from the Bank of Canada, perhaps as soon as April, as you're, putting out there, how aggressive do you think they would be with rate cuts this year?
Right. So on the U.S. side of the border, the market started the year pricing in 6 rate cuts, which was way too much. And so that's been ratcheted back down to 3 rate cuts, basically June, I believe it's August or September, and then December. I think on the Canadian side, we're factoring in, again, 3 rate cuts starting in June right now. So there is a little bit of friction around if the Bank of Canada did go sooner in April. That might surprise the market a little bit. But again, you've got those opportunities through the Monetary Policy Report, the Business Outlook Survey, to kind of lay the groundwork to say this is what's happening and this is what's coming.